Welcome to the Business SOS podcast. This is Rich Sierra, President of Florida Small Business Legal Center. This is episode 105 of the Business SOS podcast. Today we're going to talk about fatal mistakes business owners make when buying a business. And if you heard me before, I've done similar episodes in the past. I want to try a different take here. There might be some common themes, but they're worth repeating since I'm currently seeing some customers that are looking to buy a business. So this will be a helpful episode for them as well. Buying a business is different than buying a residential property. In a residential property, you have some embedded safeguards already in place. You have a title company for the most part that will handle some of the paperwork, if not all the paperwork. You have a mortgage company that is involved in the financing process, unless the person is buying the property in cash. For the most part, a mortgage company is involved. You have maybe a realtor or a real estate broker involved. So there's several people that are involved in the transaction. And by the very nature of the transaction, there's some common established guidelines that must be met before a transaction is completed. And I'll give you an example of that. If you're buying, like we buy a home, you get a mortgage, so the mortgage company say, okay, you got to meet these requirements. Make sure that we don't have a lien on the property, that wherever the mortgage is already paid, whoever is in a different position. And the title companies do lien searches to make sure that there's no lien in the properties. They require a title insurance. They require homeowners insurance. So before you actually close, as you probably know, there's a lot of requirements and checklists that have been completed before you actually get to the closing table. And because the bank will not release the funds and will not close on the property unless all those prerequisites have been met. That is different from buying a business. And buying a business, yes, there are guidelines, but they're not. You don't have to do them. And that's the reality. Somebody can buy a business, go in and pay cash, and they say about the business, and they give them one piece of paper. It's not what I recommend, but it has happened. So you don't have kind of some embedded safeguards in place that will protect the business owner from buying a business that is just should not be purchased. And I'm just going to go ahead and give you some examples of that. So one of the fatal mistakes that some business owners make when they're buying a business, and they fail to conduct the proper due diligence. And what is due diligence? Due diligence is investigating everything, all the financials of that business, goodwill of that business, inventory, everything on that business is basically looking under that hood and making sure that whatever is represented from the seller, it is true and accurate. And that the business that you're buying is the business that it's consistent with the representations that were made to you. And in some cases if you go to some websites that have listings for businesses, and you have some basic information about the business, about the gross sales. You have information about the, how long it's been in business, why the owner is selling, but you don't have a lot of information. But it's a listing, it's an ad. And based on that, you said, okay, I'm interested in learning more about it. So one of the things in due diligence is important to look at, and I'm not going to go into a very in-depth due diligence analysis here. I did that a few episodes. I think about last year I did one of those, but maybe I'll do it again at some point. Is that, you look at their financials, for example, the tax returns, bank statements. Not just 1 year tax, you look at 3 or 4 years of tax returns. You look at bank statements, payroll records, employee the employee list, employee records as well. You look at everything in that business and then determine whether or not they have any loans, any liens, any lawsuits. Although all that, and again, it's not comprehensive, but you need to look at that information, and there's a process on buying that business that should be had. Now, can you buy the business by looking at any of that? Yes. And that's what I'm saying, that is different. When you're buying a residential property, for the most part, a title company will conduct a title search. You can buy a business without conducting anything. So that's why it's important when a business is going to be considering buying a business, you have to conduct a proper due diligence. And what I see happening is that when people come to my office, I bought this business not making the money that I thought I was going to be making. And I said, well, what type of due diligence do you conduct? And in some cases, they conducted proper due diligence. But in many cases, they did not. And I've seen situations that they look at the prior year's financials or tax returns, but not the current year. And I said, what happened with the financials for the current year? They were an extension. And I said, why do you buy the business? I look good. And I get that answer. The owner told me that it's fine, that the numbers look good. So what about the bank statements? You get the first 6 months, but don't give you the last 6 months. As baffling as it sounds, it has happened that the purchaser has accepted limited due diligence and for whatever reason has not demanded to provide all the information and has gone ahead and purchased that business anyway. That is not the responsibility of the seller. As the buyer, you need to demand and require that all the documents be provided to you. And if they don't provide those documents to you, you do not have to buy that business. That is important to know that. Even if sometimes they give those documents, I've seen situations the documents are not reviewed properly. They provide the due diligence. You find out the business is not making the money that it's supposed to be, that they represented that it was making, and they failed to recognize on the financials. The tax returns give you one picture, the yearly revenue, because you file those at the end of the year, at the beginning of the following year for the prior year. But it doesn't tell you about the cash flow. What are the monthly sales of that business? What are the weekly sales of that business? What are the operating expenses of that business on a monthly basis? So it's important to understand, to have somebody help you with that in analyzing that information. But what I see here is that the failure of proper due diligence is fatal, and it can cost people hundreds of thousands of dollars. And I've seen that in my practice. Another thing that I see here is that, they don't verify whether the business has any debts or liens. And that's something that can easily be verified. And an attorney can help you with that. Any liens are public record. So we can find that information. But in some cases, they just signed it, buy the business without checking whether or not the business has any loans outstanding or any liens. So because there's not a requirement to do that beforehand, if you do not ask for that information, it will not be provided to you, especially if you're buying the business cash. Whether the lease is assignable or not. Most leases are assignable, but some landlords may require additional deposits, may require the current seller to stay in the personal guarantee, may not extend the lease. And it's important to know, this happened to me a few years ago, that one of my clients, that she purchased a business and the owner of the business told her, don't worry, just pay me the rent and I'll pay it to the landlord. And when she went to get her business tax receipt, the city told her, you need a lease. We cannot give you a business tax receipt. It used to be called the occupational license. And then she went back and said to the property manager and said, hey, I need to get a lease for a business tax receipt. And they told her, no, you cannot. You're not even in a lease. You cannot be here. So they got her out because, in essence, she was trespassing. She was literally trespassing in the property because, A, she was not a tenant of the building, of the business owner. And number two, she was not registered. She didn't have a business tax receipt. Yet she paid for that business based on the representation of the owner. Don't worry, pay me and I'll go ahead and pay you and pay the landlord. And you're probably asking the question, did she have a lawyer? No, she did not. Listen, I'm not judging here, but these are mistakes that can be avoided. Another mistake that I see is that not structuring the deal properly. And here it's more, I'm going to give you more of a big picture perspective here. When I ask my clients they want to buy a business, I ask them, is it going to be an asset sale or a stock purchase or a membership purchase, or the LLC, in the LLC case? In many cases, they don't know. In some cases, they do. So there's a distinction here. You're buying the assets of the business. You're buying the goodwill, you're buying the inventory, you're buying the going concern, you're buying what makes the business run. The customer list, vendors, everything. You're getting the contracts, you gain everything that makes that business operate. The trademarks, intellectual property, telephone numbers, everything that makes that business run. What you're not getting are the debts of that business in most cases. You're not getting those prior obligations. You're only buying what is going to help the business run, what makes the business run and going forward. That's the asset sale, the equipment. In the case you're buying the entity, then it becomes a stock purchase in the case of a corporation. In that particular case, you are stepping into the shoes of the owner and you're buying the interest in the company. And there are different circumstances, which one is better than the other. But for the most part, when somebody's buying a business, they're buying the assets of the company. They're not buying the actual entity. They don't want to absorb, if they have any tax liability of the past, they do not want to have that responsibility. They want to basically have the business clean going forward from the date of the closing of that business. So structuring it is very important. Whether the business is as cash sale or the owner is going to finance a portion of the sale. And there's no right or wrong answer to do this, but if it's a cash sale, if you're buying the business cash, there's not going to be an incentive for that owner to stay around to help you. Because once you get the cash, they'll do their time that they're contracted to do with respect to transition. After that, you're on your own, okay? And that's generally speaking, of course. If there's a portion that is financed by the business owner, 10%, 15%, whatever the case may be, that you have a promissory note being paid as part of the purchase price of that sale, of that business, then the business owner may have an incentive to assist you because he or she knows that, hey, you have to do well in order for me to get paid my loan. So just the structuring is very important in how the business is going to be purchased. So in that there are many different combinations. Again, there's no right or wrong answer here, but an accountant and an attorney can help you with the structure. But I'm just giving you some general guidelines on how to structure the deal so that way you don't take 100% of the risk, for example. Let's see if this in... Okay, I'm going to include it in this one. Okay. And in terms of not structuring the deal properly, I'm going to include here, there's not reviewing the lease agreements or negotiating proper leases with the landlord. As I mentioned, leases are assignable for the most part, but understanding if you're going to take over a lease, you have to review that lease carefully and not just make a blanket, I'm going to accept all the terms. Even if you're going to assume a lease, you still can negotiate some of those terms, especially if the lease may have, say, 3 years remaining on the option to extend the lease. If you're going to buy a business, you're probably going to stay there more than 3 years. So negotiating an extension of that, whether it's two additional 3-year extensions or whatever the case may be, is important because you need to have stability in where you're going to be operating. So if you buy the business and it's only 3 years left on that lease, you do not negotiate an extension, you're 3 years into your business. At about 2.5 years, landlord's going to give you a brand new lease at whatever terms he or she chooses. And if you already have a certain budget that you wanted to stay within, of course, there are going to be increases on that lease that were not pre-negotiated. You're at the mercy of whatever the landlord states at that time. So it's important to have the foresight to say, okay, if I'm going to be in this place, say, for 10 years or 5 years, I need to make sure that I have a lease that covers that time period that you're anticipating to stay. And I see many people just kind of blowing off the lease, not giving the importance that it should be given, and accepting a very short-term lease while they're buying the business and making a significant investment. So there's some of the things that should be looked at as well. Another thing that I also see is that people don't prepare. I'm a big proponent of having letters of intent. They go straight to the purchase agreement, if they have one, without having a letter of intent first. What is a letter of intent? It's exactly what it means. It's simply a letter that has kind of the key provisions of the transaction. It doesn't have everything there, or the boilerplate provisions that are included in a larger document. But I like to have an outline of what the transaction is going to be, the basic terms. Who's the seller? Who's going to be the buyer? What's going to be the purchase price of this transaction? Is it going to be a cash deal, 100%, or is it going to be a certain percentage? It's going to be financed by the seller, and at what terms? What is going to be the down payment? 10%, 15%, whatever the case may be. What is going to be a due diligence period? 30, 60 days. Are there any contingencies that if they're not met, the deal can be canceled? That's important. That should be in the letter of intent. I'll give you an example. If the buyer is looking for SBA financing, and that could be a contingency. That says if I'm not able to obtain the financing, then the deal is off. Then I'll get all my deposits back. The seller doesn't have to accept that, but that's something that should be included as part of the contingency in the letter of intent. And again, the objective of the letter of intent is to have some clarity without having to draft a larger document with respect to the transaction. That's all it is. And also how much down payment you're going to put in as part of to make that consideration. Once we get through the letter of intent, then we go into the purchase agreement that is drawn from information. The letter of intent is a more expanded document. It goes into, for example, due diligence period, but what happens, when can the buyer cancel the contract without incurring any penalties? That will be part of the purchase agreement. Warranties and representations that the buyer and seller will be making. At that point, the due diligence checklist is provided to the seller to provide all the documents. So just to give you an example on that. Another mistake that I see here, I think it's mistake number 3, is that the purchase agreements fail to include very important provisions. And again, I'm not going to go into every provision that the purchase agreement asset purchase agreement should include. That'll be a different topic in and of itself. But I don't see protections in some cases. I see a one-page document. And I'm not exaggerating when sometimes I see a one-page document, handwritten, that say, I buy this business for X number, and they sign it. Okay, that's fine. At least it's something. But it's not adequate. And then it's not they're buying the business for $5,000. Sometimes see $300,000 or $400,000 in these transactions on handshake agreements or very, very poorly written documents. And it's surprising to me, somebody spending that type of money buying a business, and they choose not to get professional advice to get it done right. Then what happens is that a dispute arises as to the interpretation of what each party was expecting to receive or give, and litigation inevitably happens. That could be avoided through the purchase agreement letter of intent properly drafted by professionals. To give you an example, I see missing non-compete and non-solicitation provisions, meaning that the seller cannot compete against you within the area of your market area, whether it's 5 miles, 10 miles. The seller cannot go ahead and push your employees, your new employees, because you take that knowledge base out of your business to open a new one. You're gone. It's going to be difficult to recreate that. How long would the business owner will stay during the transition? That's important to also include there. Will there be a holdback of money for a certain period of time based on certain performance? That's something that can be discussed, or whether or not that's going to happen. In some cases, a holdback to account for any unexpected expenses that they were not disclosed, or unaccounted for, and then those funds are released, say, 60 days later. There are many different ways to craft the purchase of a business, and that's kind of my point here. In a residential type of purchase, you have a very strict, very predictable way of buying the house. When it talks about business, white canvas, we have some guidelines, we have some practices that are customary with these types of transactions, but pretty much you can really be creative in how to buy a business. But for the most part, it will not be a structure that's buying a residential property, which is good to have that level of flexibility and creativity, but it's bad if you do not know what you're doing, or you don't have someone that knows what they're doing, he or she's doing, to protect you, to make sure that you're protected when you write that check, or wire transfer, with the case may be. Okay. Number 4, not reviewing key third-party agreements. And I think I mentioned already lease agreements, not reviewing them properly. It's essential to review those documents properly, and preferably by counsel, for you to understand what you're getting into. But also, if you're in a plaza, for example, if it's a retail area, talk to your future business neighbors. Talk to them. How's the landlord? How do they provide you support? It's important to know what type of relationship you're going to have with this landlord going forward. If something breaks, are they going to fix it? What are you responsible for in that lease? Those are things that you need to understand. When in segment number 4, and mistake number 4, I'm also going to include not understanding how that business is generating revenue. And I'll tell you what I mean about that. Is that in some cases, you need to find out where the business relies on 1 or 2 key accounts. And I'm being very general here, okay? If the business relies on one specific customer to generate most of its revenue, or the business has a multiple number of clients that if one decides to change or not pursue it, not continue with the business anymore, the business can continue. So understanding how that percentage of revenue in relation to the customers is very important. Okay. And I'll give you, an example of a CPA firm, accounting firm. What is their customer spread with relation to how many taxes they do, what type of consulting work they do, or is it one client that generates most of the revenue? So understanding that is very important, because in some cases people buy these businesses and a key account leaves. And I'll give you an example of an ad agency. An agency sells, they have customers, but then what happens if 30% of the revenue comes from one key account that has a relationship with the owner, and then the owner leaves, and then that particular customer decides, what, I just don't feel comfortable, I'm just going to go somewhere else. Necessarily to the prior seller, prior owner, but someone else. So what is the impact to that business if a key customer leaves? So understanding that is very important about the customer spread in relation to your revenue. So that is, and also understanding, which I see that often, the lack of understanding and how many sales a business has to make on a monthly basis to keep the doors open. When I ask that question, sometimes I get a blank stare. If you're buying a business, you need to know that, because initially in that business is going to be a little bit of a learning curve before you ramp up. And what are the working capital requirements to maintain that business afloat? That's very important. An accountant can help you with that. A business attorney can help you with that. But those are the questions you need to ask. Here in terms of franchise agreements, franchise is a different topic, and I covered that before. But understanding that if you're buying a franchise, then you're dealing with more of a three-party type of transaction. You deal with the franchisor that you obviously got to accept, whether it's a brand new franchise agreement you're signing or you're taking over somebody else's franchise. Then you have to have franchisor approval, which is, understanding the franchise agreement, the FDD. That's one aspect of it. Then you'd have to deal with the business owner, understanding, doing the same analysis and due diligence like any other business, and you're dealing also with the lease of that particular franchise, dealing with the landlord. So when you add the layer of the franchise, then it becomes a little more complicated. Not impossible, but dealing with, obviously, another party, because there's some additional requirements when you're buying a franchise. Mistake number 5, not considering post-sale integration and planning. Okay? So, like any business, there's going to be transitions. And those transitions have to be properly negotiated. And so, depending on the type of business that someone is buying or you're considering buying, how many employees are planning to stay after the owner leaves? That's important to know. And I see in some cases, or in most cases, the business owner does not want you to know that he or she's selling, because then people may leave. And you obviously cannot require the employees to stay. So how do you navigate that? And there has to be some type of assurances, or financial assurances, or some fashion, that the employees will stay for a period of time to allow you to have that transition. Otherwise, if everybody leaves, you buy that business, you're going to have a huge problem, not only in personnel knowledge, but also on providing services. So how that transition takes place is important and has to be negotiated beforehand. An example would be, you guarantee the employees will stay for at least 6 months. Just give you an example. And for that, if an employee leaves, I'm going to have $5,000 for recruitment. And you can hold that back. If they stay after a certain amount, then you release that money. So it just kind of provides some type of incentive for the owner to tell employees everything's going to be fine, it's going to be in the owner here, and really encourage them to stay for obvious reasons. But it has to be some type of transition plan that has to be in place in order for you to have a proper takeover of that business. The owner also has to provide training for a period of time. It depends on every business, whether it's 2 weeks, a month, and also available for phone calls if necessary. So you have to make that transition, negotiate that. Also the transferring of the merchant account. In some cases, you buy the business in one day, you're not going to have your merchant accounts ready the next day. So you might have to use the current owner's merchant account for a period of time until yours become available. Then you can switch that over. So that revenue goes to you, but that has to be put in writing that the revenue going into the account from this point forward will have to be given back to you. Okay? And then they have to provision for chargebacks as well. Obviously, the time might be a week, for example, but now I think you can get merchant accounts relatively fast now. That it was not like before you had to wait for the machine to come to you. You can get those very quickly now. So it's a little bit less of a time or burden to wait for the merchant account to come in. Understanding how, in terms of the employees, having meetings with employees is important. Having that confidence, giving them the confidence and comfort that they will be okay. And you want to ensure that the business runs smoothly after you take over. So that really goes more into communicating with them and making that transition. But a mistake that I see here is that people don't make that transition, and the owner has to cooperate and help with that to make that transition now as you're taking over a new company. Bonus mistake, and I'm sure you'll know which one this mistake is buying the business without the assistance of an attorney or an accountant. I think the accountant and the attorney should be part of your team to purchase that business. The business attorney will help you look at those documents, will help you make sure that the contract protects you as the buyer of the business, and helps you with the due diligence process. The accountant will make sure that all the tax returns have been filed properly, the payroll taxes have been paid, will identify red flags in the financials and tell you, okay, listen, there's a decrease in sales this particular month, find out why. We'll tell you how much the owner is getting in benefit from the business. So the accountant is an essential team member for your purchase of the business. Don't go at it alone. I don't recommend anyone buying a business by themselves without the assistance of an accountant and an attorney. This is good for today. I hope you enjoyed this episode. Again, it's episode 105 of Business SOS podcast. If you have any questions, you can send me an email at richsierra.com. If you want to learn more about my legal services, my website is floridasmallbusinesslegalcenter.com. If you want to give us a call, my number is 866-842-5202. Also, you want to watch the video of this podcast, we're on YouTube at youtube.com/@RichardSierra. Remember that my book, Business SOS, Como Legal Mistakes, Business Owners Make It, Business Owners Making How to Avoid Them, it's available on Amazon, Barnes & Noble. You can ask for your local bookstore. Until next week, this is Rich Sierra. Remember that my goal is to help you succeed.